DraftKings is an interesting online gaming company where people can play daily fantasy sports. They could play mobile games like blackjack, etc., depending on the state they're in, if it's approved in their local jurisdiction. And they can bet on the outcome of sporting events, for instance, who's going to win the Super Bowl or who's going to win tonight's basketball game. The company is gaining new customers at a rapid rate, revenue is growing, and it's exciting a lot of investors. So in this video, I'm going to evaluate DraftKings stock doing a discounted cash flow valuation model to determine what I think the intrinsic value per share for DraftKings stock is. Or in other words, what do I think is a fair price to pay for DraftKings stock? So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Okay, to make this calculation, I'm going to use a lot of inputs, and I'm going to share with you where I'm getting almost all of the inputs. Okay, the ones that I'm not going to share with you, they're inputs that are readily available and are probably common among all investments. But I'll try and share with you as much as I can. It's a brief video. So starting with the company's market cap, which stands at 19.35 billion. I also need the number of shares outstanding, which are 486 million. I need the long-term debt at 1.256 billion, and I need the cash and equivalents balance at 877 million. I also need the beta, and according to Yahoo Finance, the beta for DraftKings stock is at 1.82. Beta measures the price movement of a stock over the previous 5 years on a monthly basis, according to Yahoo Finance in this calculation. It determines how much a stock price moves compared to the S&P 500 index. So a beta of 1.82 means that DraftKings stock moves 82% more than the S&P 500 moves. For example, if the S&P 500 goes up by 1%, DraftKings stock should go up by 1.82%, 82% more. And the same thing on the downside. If the S&P 500 goes down by 1%, DraftKings stock should go down by 1.82%, meaning it's more risky than the market overall. And that makes sense for a company like DraftKings, highly connected to economic activity. And so when people are working and their income is increasing, they are more likely to spend money on online gaming like DraftKings. And the opposite is also true when people lose their jobs and they're fearful about their income prospects. They're going to have less money to spend on gambling online. And so it's a business that's connected to the economy. And when the business is connected to the economy as strongly as DraftKings is, they tend to have larger betas. On top of that, when a business is in early stage development, early stage growth, it tends to have a higher beta because the future prospects are not as well grounded as a company that's more established, that's been around for a longer time. Just a couple of factors on what the beta means. I also need the company's free cash flow estimates, and according to the Wall Street analysts that are following DraftKings stock, they expect the company to deliver 190 million in free cash flow in 2024, 880 million in 2025, 1.37 billion in 2026, 1.59 billion in 2027, and 2.18 billion in 2028. A large percentage of this increase is due to the company entering new markets. It's not available in every state in the United States just yet, but it's expanding, and every year it adds a few states to the mix. That's one of the main drivers that's increasing the company's cash flow, is that it's entering new states and expanding within those states and finding excellent growth with each new state it expands into. All right, so now that we have all the inputs we need, we can jump into the valuation model. Starting with this left-hand side here, I have on this row all of the free cash flows estimated from 2024 out to 2035. The first several years, I shared with you where I got the free cash flows. From those years onward, from the year 2018 onward, I have the company from 2029 to 2034 growing at a short-term transition period growth rate of 20%. So in the next 5 years, they're going to grow their cash flows rapidly according to Wall Street. They are expecting a more than 10x increase in their cash flows from 2024 to 2028. I don't think the company's going to grow at that high rate beyond that point. I think it's going to slow down. I have it slowing down at 20%. You can argue it's going to grow by faster than that over the next 5 years, and I would be open to that argument. I chose 20%. From 2035 onward, I have the company settling down to its long-term growth rate at 5%. I have it growing at just about the rate of nominal economic growth, nominal GDP growth, which I expect to be around 5% over the longer term. So those are the values of the cash flows forecasted out. But because they're in the future, we need to discount those cash flows back to today, get the present value of those cash flows. To do that, you need to get a discount rate. And that's where I use the weighted average cost of capital formula, which adds together the cost of debt and the cost of equity to come to a weighted average cost of capital. Since the company has 1.2 billion in debt and a market cap of 19 billion, I have the target capital structure at 95% equity and 5% debt. I give the company a cost of debt of 8.5%, adding more than 400 basis points because of the extra risk you're taking with DraftKings debt compared to buying a US government bond, which is theoretically zero risk. I shared with you the company's beta is 1.82. And when I use the capital asset pricing model to get the cost of equity, applying the beta to a risk-free rate of 4.2% and a market risk premium of 6%, I get a capital asset pricing model cost of equity of 15%. So combining all those, I get the cost of equity, the weighted average cost of capital, 14.79%. So when I apply that discount rate to all of those future cash flows, I get the value of the company's operations, the present value of the free cash flow that DraftKings expects to generate between now and infinity. That's the value of operations at $30.5 billion, the present value of the company's operations between now and infinity. So to this total, we need to add the company's cash, which was 877 million, and subtract the debt to arrive at the value of equity of $30 billion. But we want to know the value per share. So we divide the number of shares outstanding of 486 million, and I get an intrinsic value per share for DraftKings stock at $62. Given the current market price is $39, I see undervaluation in DraftKings stock at current prices. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.